Here to help me put Goldman's earnings into perspective is Brad Hintz. During the 1990s, Brad was CFO of Lehman Brothers, and currently he's a securities firm analyst at Sanford C. Bernstein. Brad, welcome to Bloomberg's Bottom Line. You've been here for the hour. Thank you for your patience.
Thanks for having me.
Press conference. First, a reaction to Goldman's earnings today.
Well, it was not a great quarter in the trading side. I don't think it was a disappointing quarter. You came in right on what the analyst estimates were. What surprises me was the market's response, and I think one of the mistakes that you had is that Goldman changed its segment reporting, which made it very difficult for an institutional investor to just take a look at the Goldman press release and figure it out. And so as a result, when they saw the numbers were going down in fixed income, caused a fright in the marketplace. I took a look at Goldman's history, and since we have 12 years of history on Goldman Sachs, in 10 of those years, fixed income declined in their fourth quarter. And David Viniar, their CFO, made a wonderful little understated comment. He says, well, typically things slow in the fourth quarter. Yeah. Well, I called a trader, and the trader made a more compelling argument. He says, no one trades in December. He said, if you do well, your bonus doesn't go up. If you do badly, they take it away from you.
So we should at least, for purposes of this discussion, understand that when we're talking about December, the CFO, David Viniar, said Goldman's customer activity in December was, quote, just dead. How are Goldman's relationships with its larger clients?
Well, I don't think that's the issue. What you had, I mean, you read Bloomberg like I do, and what did we have in December? A lot of uncertainty about municipals, concern in the mortgage market, QE2 caused
about the Bush tax
that's right. QE2 caused yield curves to move.
Sure.
I mean, this is not an environment where fixed income guys wanted to make a lot of bets, and so you saw trading activity slow in anticipation of what would be the beginning of the year.
Is the fixed income cycle over?
No, not at all. No, what you're going to have is you're not going to have a 2009. What you're going to have is you're going to have a slow recovery of trading activities in Europe as the European economy picks up. Remember, the European fixed income market, U.S. fixed income market, roughly the same size. And so what we will have is pick up in Q1 in terms of fixed income, not a boom because it's a slower environment than what we had before. But we don't have an environment where the yield curve is going to flatten. As the yield curve flattens, trading volume moves to the short end of the curve, and that's where it kills the fixed income cycle. So we probably still have another 3 quarters, 4 quarters to go domestically before you start seeing the fixed income cycle really ending.
Brad, compensation at Goldman down about 5%. Was that due to regulatory pressure, or is there a sea change happening on Wall Street?
Well, a combination of two, right? You want to be friends to your regulators, and Goldman, as the leader of the industry, certainly is taking a lot of attention right now. But I would say the other one is, Basel III is really changing the returns that you're going to get from the trading side. Yeah. So the way to adjust to lower returns on trading is to reduce the amount of capital that you're going to commit to trading, and push your clients for a little higher spread, a little higher commission, and third, bring down your own compensation. And it really looks like the street is moving in that direction.
Brad, a couple of questions about Morgan Stanley. As I mentioned, its focus differs from some of the other Wall Street firms. It bet its future on the brokerage business. When are we going to know if that strategy is paying off?
Well, we hope you'll see some performance improvement. Remember, they had an 8% pre-tax margin in their retail business last quarter. Well, they're behind in terms of the integration of Smith Barney and Morgan Stanley. And, we assume they're going to be able to get there. But, they're having technology difficulties putting them together. So they're in a race. They have to get that integration in place.
Is that one of the biggest wild cards to its success?
Yes. It's when when will retail come back? We're beginning to see the recovery in retail trading volume. You're seeing that in Ameritrade numbers and in Schwab numbers. It's still a very early stage. So it looks, and this is Bernstein's estimate, 2012 is when retail comes back. So Morgan Stanley has a year before they really need to be fully integrated. Yeah. At that point is when you're going to see that Smith Barney, Morgan Stanley new business model, the operating leverage pop.
All right.
In the meantime, tough one.
About 20 seconds. Morgan just naming Greg Fleming the new head of its brokerage business. Doesn't he have more experience with bankers rather than brokers?
Well, that's very true. He is, however, a great extrovert, a people person, and what I suspect you've got here is a man who can go and press flesh with the brokers, keep them happy. Remember, Morgan Stanley really needs to keep turnover rates low.
Yeah.
It wants to come out of this integration process, and integrations are very difficult, with a broker headcount that's greater than Merrill Lynch.
All right, Brad Hintz sticking with us through the hour, through the press conference, talking Goldman and Morgan. Brad, thanks for your patience.
Pleasure.
Appreciate
Thank you
it.
very
Always
much.
good to see you.